we're back with another tax video. So I've been working on this video series breaking down the IRS account transcript transactions line by line, code by code, and I'm just about to get to the release of the codes 766 and 768 videos on tax credits, and I thought this would be the ideal time to discuss the subject of deductions, tax deductions versus tax credits. So I'm going to break down the difference between the two as simply as I can to try to help you understand why your tax refund is the size it is, or maybe the amount of tax you owe to the IRS is the amount it is. And hopefully by the end of this video, you'll have a better understanding of how those two things affect your taxes. And then in a second part of this video, I'm going to specifically talk about a question I've been getting from hundreds of my subscribers over the past several months about the unemployment deduction specifically and why you may not have received a refund from that adjustment. So that will be in a separate part 2 video once I've explained the difference between deductions and credits, because you need to understand that the concepts in this video to understand the intricacies of the second part of the video. Also, understanding the difference in these deductions and credits will help you understand your transactions on your account transcripts a little better as well. So let's get into it. First, we're going to look at deductions. So tax deductions are a non-refundable amount of money that reduce the amount of taxable income on your return. Deductions do not directly affect the amount of a tax refund. Rather, they indirectly affect the amount of a tax refund or the amount of a tax owed by way of how they reduce your taxable income. So indirectly, because of that deduction reducing your taxable income, maybe you would now qualify for credits that you wouldn't have without the deduction, or maybe because of the deduction, the amount of tax based on your income is lower, meaning the withholding you had throughout the year on your W-2s, you overpaid on, and you get a refund from that. But a deduction is not a dollar for dollar equivalent on your refund, meaning if you had, say, a $15,000 tax deduction, you're not getting a $15,000 refund. All it means is whatever your income was, that deduction would be reducing your taxable income by $15,000. Now, everybody's tax situations are different, and everybody qualifies for different deductions, but some examples of common deductions would be the typical standard deduction. That's for people that don't itemize their deductions on their tax returns. Deductions for property tax paid, mortgage interest paid, charitable contributions, medical expenses, education expenses, interest paid on student loans, retirement, business deductions if you're self-employed or own a business. Maybe you itemize those deductions as well. Maybe you have gas mileage deductions, and of course the unemployment deduction. So let's just take a basic example of a deduction and how it works, and then you could extrapolate these examples I'm going to give on these different things to your own situation. Meet Jack. This year, Jack had a gross income of $32,000. He had $24,000 from his employer, but he was laid off briefly for a few months this past year, and he received $8,000 in unemployment. Jack is single and has no children. All of Jack's work income came from the W-2 from his job, so he has no business expenses to deduct. This means that Jack is going to qualify for 2 deductions. The first would be the standard deduction. The standard deduction for this year is $12,550. He'll also qualify for the unemployment deduction. Now, the unemployment deduction is $10,200 maximum, but he didn't receive $10,200 in unemployment, so he's not getting that much of a deduction. He received $8,000 in unemployment, so his unemployment deduction will be that full $8,000, and he misses out on that other $2,200. So, with Jack's standard deduction of $12,550 and his $8,000 unemployment deduction, his total deductions on his tax return are $20,550. This amount will be deducted from his $32,000 of income that he received, meaning his total taxable income will be $11,450. Now, this is very basic, and his taxable income may actually be considerably lower because this would actually be considered a low-income individual, and there's all sorts of like kind of tax breaks and stuff. But basic description of how these deductions work. I'm trying to break it down on this little micro level to help you understand. So for the purpose of this example, his taxable income is going to be $11,450. So you can see here, there is no refund calculated at all within this deduction. But because this deduction has reduced his income, his tax will now be a little bit lower than it would be had he been taxed on that total of $32,000. Jack's adjusted gross income has now fallen below the earned income credit of $15,000 for a single individual with no children, so he's also now going to get an earned income credit, which will make his refund a little bit bigger. So before we can look at Jack's total tax picture and the refund he's going to receive, we need to talk about credits. Credits are amounts of money that directly reduce the amount of tax you pay. And in some cases, tax credits are refundable, meaning that you can receive anything over that a tax credit after your tax due has been paid as a refund. Some common examples of tax credits are the child tax credit, the earned income credit, the advanced child tax credit, energy credits, stimulus payments are considered tax credits, child and dependency care credits, and there's many more, but those are some basic ones. It is important to note that as of 2021, Congress changed the laws on the child tax credit. Child tax credit used to be non-refundable, meaning, like say you had a $3,000 child tax credit and you owed $2,500 in taxes, they would apply that $3,000 to your tax owed, but you wouldn't get the $500 left over. As of 2021, when they redid some of the tax laws, child tax credits, for now, it's not a permanent change, but for now, child tax credit is refundable. That started when they started doing those advanced payments on child tax credit. So now any child tax credit you get is fully refundable. So it will directly reduce the amount of tax you owe, and then the balance of whatever's left you do get as a refund. So let's look back at our friend Jack and see where he stands and if he gets any of these credits. So, as we left off, his taxable income is now going to be $11,450. And after all the calculations, the amount of tax he owes to the IRS is $3,435. Now, let's say he paid $800 in withholding on his unemployment, and at work, his W-2 shows as federal withholding at $3,200, leaving a total withholding amount of around $4,000. Let me just reiterate that this is a very, very basic example. I'm obviously leaving out some information like Social Security withheld, Medicare withheld, etc. I just want to give you a basic breakdown of how these deductions work and how they can affect a refund indirectly. So after the withholding, we get his refund amount. But we also talked earlier about that now that his income is a lot lower and he's under that $15,000 adjusted gross income threshold, he will also qualify for earned income credit. He's a single individual with no children, so his earned income credit this year is going to be $560. That will get tacked on directly to his refund of $665 that he already had after his withholding was deducted from his tax. This means that Jack is getting a total refund this year of $1,225. Jack's pretty pumped because he was a little afraid he was going to owe money this year after getting unemployment. This is because he didn't fully understand how deductions and credits work. But now, after this video, he does, and he fully understands why he's getting a refund. And now, so do you. With that said, please look out for part 2 of our video when we discuss the unemployment deduction specifically and why you may not have received any refund after the IRS adjusted your return.